Most people view a bank as a secure locker room. You deposit your money, it's locked behind steel, and those physical stacks of cash sit in the dark waiting for their owners. In reality, a bank is an industrial factory where the raw material is other people's money. The moment a deposit arrives, it is processed into loans, bonds, and investments that generate income every single day. This process, called fractional reserve banking, allows a single deposit to multiply. When you deposit $100, the bank holds $10 in reserve and lends out the other $90. When that $90 is spent and redeposited, the cycle repeats. That $90 will split into $9 of reserve and $81 of new credit, cascading until the original deposit helps move $1,000 through the economy. A modern economy functions because of this mathematical multiplication, allowing capital to flow without the need to physically print a new dollar for every loan. Entering this industry requires immense upfront costs. Before accepting a single customer, a new bank might spend $30 million and 3 years navigating regulatory applications to prove its management and risk frameworks are sound. The primary engine for recouping that investment is the spread. A bank borrows money at low rates from depositors and lends it to borrowers at higher rates, collecting the difference on every transaction. The true scale of banking profits comes from leverage, the practice of generating returns using capital that the bank does not actually own. To see how this works, imagine a bank with $500 billion in deposits sitting on just $5 billion of its own equity. If the bank earns a 1% return on those total assets, that profit flows entirely to the owners. In this scenario, a thin 1% margin on the deposits translates into a 20% return on the bank's actual capital. JP Chase demonstrated this scale in 2024, reporting an annual net profit of $58 billion, the highest in the history of American banking. By sitting at the center of money flows and applying extreme leverage to trillions of dollars, banking is a consistently profitable pillar of global commerce. The same mechanism that produces these profits also creates extreme fragility. Because a bank operates on such high levels of leverage, the math can turn against the institution with devastating speed. When a bank holds only 10% in equity, it has a very thin cushion for errors. If the value of its total assets drops by just 10%, those losses immediately consume the entire capital base. The institution becomes insolvent in an afternoon. This creates a volatility trap. A small committee in Washington can raise interest rates and change the economic environment for the entire country, devaluing a bank's assets regardless of how well the bank is managed. Major banking collapses are the mathematical downside of a system built on leverage, occurring when the assumptions beneath the balance sheet no longer hold. In the early 2000s, Washington Mutual became a retail giant by aggressively pursuing the subprime mortgage market. They sought higher interest margins by lending to borrowers with poor credit, assuming the extra income would cover the risks. The bank was led by Kerry Killinger, an executive with 17 years of experience who transformed the firm into a national powerhouse. He understood the mortgage business, yet he pushed the bank's leverage into a market that was about to disappear. When the housing market stalled in 2006, those subprime borrowers began to default. Washington Mutual's thin capital cushion began to dissolve as its loan portfolio lost value. The situation turned terminal on September 15, 2008, when Lehman Brothers filed for bankruptcy. The news triggered a wave of fear across the financial sector, as depositors realized that even the largest institutions could fail. Panicked customers withdrew $16.7 billion from Washington Mutual in just 10 days. With its cash reserves depleted, regulators seized the bank and sold it for a fraction of its former value. The bank was destroyed by a sudden run on confidence. A 17-year legacy vanished in less than 2 weeks because the bank's balance sheet could no longer sustain the public's trust. Silicon Valley Bank demonstrated that even a bank without bad loans can collapse. They took deposits from tech startups and invested them in long-term government bonds, the safest assets in the world. Their failure was a matter of timing, known as a duration mismatch. When the Federal Reserve rapidly raised interest rates, the market value of SVB's older, low-yield bonds plummeted, creating a multi-billion-dollar hole in their books. By late 2022, SVB held $17 billion in unrealized losses. Simultaneously, the tech sector cooled, and their clients began withdrawing cash to fund their own operations. The end came at the speed of a text message. A hyper-connected group of venture capitalists began advising their companies to pull their money out. In a single day, customers attempted to withdraw $42 billion, nearly a quarter of the bank's total deposits. Silicon Valley Bank proves that an institution can be erased in 44 hours, simply through an interest rate mismatch and a digital loss of faith. These multi-billion-dollar failures among experienced firms are inherent to a system built on high leverage. When assets lose value, the thin layer of capital protecting the bank evaporates. Once public fear takes hold, the momentum of a bank run becomes unstoppable. No amount of capital can move fast enough to counter a mass withdrawal of deposits once the cracks in the system begin to spread. The math of banking provides the profit, but a fragile psychological element keeps the doors open. The entire system relies on the assumption that everyone will not ask for their money back at the same time. Owning a bank involves maintaining a complex machine that converts collective trust into capital. It is an enterprise that exists entirely on the assumption that the trust will never run out.